This is the Texas Land Guys podcast, hosted by brothers Tim Dosh and Tom Dosh. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Welcome to the podcast. Tim, good to be back here with you.
Yeah, it's really good. It's been a while, so it's good to be back.
We're fighting a little bit of jet lag this morning. I think you just got back from being overseas. We're here in the middle of summer, so you were with your family. So I felt bad that we scheduled this recording, and we have to keep up with these recordings just to try to deliver these episodes. And I don't know if that was the greatest timing for you. So how are you feeling this morning?
I'm feeling good. I'm feeling pretty jet lagged. We were in Eastern Europe, over in Bulgaria, and also Switzerland, but Bulgaria most recently. So day before yesterday. So I'm still feeling it pretty good. It's an 8-hour time difference, but see what I can do to hang in there.
I thought it was funny. You were headed there. I was in Colorado, so I was sending you pictures of Colorado. And then you started sending me pictures of the Alps. And so I kind of felt like I got outdone just a little bit because Colorado is amazing, but the Alps look to be next level. I've never been, but is that how you felt?
I mean, I think so, but the Rockies are so amazing. We have such a history in the Rockies, being in Montana and living in Montana and then being in Colorado so much. And they're so beautiful. And I still really appreciate the Rockies. The Alps are just different. The biggest differences are such a big elevation difference between where you stay at 2,000 to 4,000 feet, and then these mountains that are 14,000 to 15,000 feet that are really close to you. So it's just really dramatic. And then the peaks are really jagged, kind of pretty peaks, which is really cool. But I mean, it's so cool that we have the Rockies relatively close to us here in the U.S. We can enjoy those too.
I know when you travel, it's hard not to think about real estate. Was there anything that stood out to you, either Switzerland or Bulgaria? I know there's a lot of history there, a lot of really old buildings, but just from a real estate standpoint?
Yeah, I mean, I'm always thinking like that. And I was interested in Switzerland to see how much of it was new. A lot of especially when you get outside Zurich, Zurich has some really cool, old town buildings that were started in the 1100s, 1200s, some of those old churches, and they have some very old buildings. But a lot of what's been built is really new. New industrial, new office, new retail. And there are times it felt like driving around a U.S. city or U.S. countryside, just the way it's developed. And Bulgaria, was a communist country until the last couple of decades. So there's a lot of old, kind of ugly communist buildings, concrete block buildings. And but there's a lot of cranes up. We were in Sofia, and there's a lot of cranes up. They're building new office buildings, building new apartment deals. Some of their apartment deals are really cool looking, like high-rise and podium deals. Really cool neighborhoods, very nicely manicured neighborhoods. Different than here, but it was less of I've been to a lot of places in the world, as I know you have too, Tom, like Africa and India and South America, and I would say it was less of a culture shock, than those places. I mean, it reminded me in some ways, both those countries are elements that remind me a lot of the U.S., some of our cities. Yeah,
that's it's interesting to see that development, to know that some of these countries, their economies are not very strong, and not necessarily speaking about Switzerland, but just, Bulgaria has a lot more challenges than maybe, some of our cities here. So then it's pretty incredible when you see that type of development activity. That always surprised me, being in places like Turkey, where you would be reading about a lot of unrest in the country and challenges, and then you'd be driving and there'd be 11 high rises being built all right next to each other at the same time. It's just a totally different way of looking at real estate and ownership and development, but pretty intriguing.
There's a lot of money, those markets, and sometimes it's not clean money. There's money laundering going on and organized crime and different things like that. Not to say that that's what all those cranes are, but they're just different economies. But it is surprising because you sometimes have these preconceived ideas of what it's going to be like, and then you actually go see it, and it's different than what you thought. But I'd love to go we didn't make it to Istanbul, but that would have been cool to go see that.
Well, welcome back. Again, we're going to make it through here with some coffee and some interesting conversation. We were brainstorming a little bit longer than we normally do about what we wanted to talk about this morning. And just as we're chatting, sometime we probably should just turn the mic on for when we're having those conversations, because I think they can be pretty interesting. But as we were chatting, the idea that I think we kept coming back to was, what are the deals that are moving the market That's in our intro for the podcast, and it's something that we get asked a lot by clients. We'll get the questions of, are you guys seeing anything happen? Because you get the more conservative clients or landowners where maybe a landowner's been put under contract and then dropped several times. And they're like, am I ever going to be able to sell my property? Or the developer that they've been looking for maybe the last 1, 2, 3 years and haven't built anything. They haven't been able to sell anything that they had built. And so the question is, are you guys seeing any land trade hands? And since a lot of the land that we're involved with is for development, it's not just investment land, there has to be a way to underwrite that property and make sense of that property for there to be development. And so I think we had a pretty interesting conversation around, like, from capital standpoint, from use type standpoint, even just different developers, what we're seeing. So why don't we maybe start with maybe just more from a use type standpoint? And I'll let you lead based off kind of what we were talking about earlier.
Yeah, where I was going to go right before we do that is it's probably, this has been a really unusual time in my career to see, or an unusual market. We've had historically, especially in Houston, kind of this boom and bust city where you have really, really good times where everything is on fire and, the prices just keep going up and there's activity really across use types and across geographic parts of the city, infill and suburban. And this has been very different. I mean, it's a weird market, like you're saying. There's literally parts of the market that are dead, geographically, and just certain developers are just not active. There's the ones that are on the sidelines completely, and then there's ones that are tying sites up that we have, pretty much no confidence that they're going to close, or something crazy is going to have to happen for them to get capitalized. And then at the same time, you have still, some record land pricing in certain parts of the city, certain use types. You have really strong developers who are getting deals capitalized. And some of that is private money, like you were alluding to, and some of it's institutional capital. So we're seeing that. So it's kind of like this weird market that I've never seen before, where you have some really bright spots and some dark spots that are happening at the same time and in the same MSA. But yeah, I think from a use type, I don't know where you want to start. On the single family side, we have seen a pretty big pullback and kind of a shift in what's happening on that side of the business. The real bright spot there is we're still seeing a lot of large acreage activity, single family developers and investment groups who are looking a little bit longer term are still buying sites. And we've actually recently closed some really big transactions in several of our markets across Texas that are just massive single family developments that are probably going to take 10, 15 years to build out. And then we're also putting a lot of those deals under contract and continue to see a pretty strong market there. At the same time, we see a single-family pullback from the builders getting much more conservative, needing land bankers to close deals or pushing the contract close period to next year. There's been a lot of groups who are like, we just don't want to close this year. We want to close next year. We're willing to put up non-applicable money to extend contracts or put up more hard money just to keep it in the pipeline, but kind of push it out. And then maybe the last thing to add there is we were seeing some really aggressive infill suburban single family activity. And we're still seeing some of those deals close. But I would say on the kind of the offer side, as far as how quick and aggressive we were seeing some of those deals go the last 12 to 18 months, that's really, really changed. And we've seen them kind of pull back from that.
Yeah, I think what you're alluding to is you have a long-term outlook that's really positive on Texas, which is something we talk about a lot. And so the belief that population growth, job growth in Texas, our major cities, infrastructure needed for that growth, the whole Texas triangle is just positioned really well for long-term growth and investment from, whether it's in our country, either coast or even international investment. But in the short term, it's challenging for these builders to make sense of some of the just fundamentals in the different markets. And so these land developers that we're closing these sites with, and to your point, these are 350 acres. These are 1,000 acres. These are 1,000 plus acre sites. We just closed just under 1,000 acres, like 980 acres in the Austin market. You guys closed over 1,000 acres down in the Houston market. And then we've had several in kind of the several hundred acre range down here in Dallas that we've closed, and then have several that are in our pipeline under contract to close. So we'll kind of see what happens, but that are closer to 1,000 acres. And those are just long-term bets on really good locations where there is growth. It's going to take years, like you said, to even just get, in some of these cases, to get water, sewer, roads, entitlements, just development, get lots on the ground. And we're kind of in this time right now where there's uncertainty, tariffs, a lot of uncertainty on interest rates, a lot of deliveries in certain markets. And so I think builders are just being told, and what we're hearing is this is coming from the top. I mean, a lot of these builders are publicly traded. They're being told, yeah, you guys gotta cool it on this incredible activity. Because we were just seeing builder activity at almost like unprecedented levels the last 12 to 18 months, just from the standpoint of earnest money they were putting hard to secure lots, how quickly they were closing, the amount of cash that they were getting out from their balance sheets. And so we see this in our business. And I know you've seen this longer than I have, just these pendulum swings of really, really active and like everything goes. And then suddenly just everything has to kind of get turned off. We're not quite to like everything's turned off, but there are a lot of areas around Dallas and Fort Worth where builders are just out of the market. They're either trying to trade lots to get out of those positions, or they're buying down interest rates to sell homes, sometimes just to break even, just to get homes sold. But then you go to maybe a core area. So where we're closing a lot of deals and seeing a lot of activity on the single family side is still McKinney, Melissa, Anna, kind of that core pocket. You're still seeing a lot of activity in those areas.
Would you say that single family slowdown is more of a macroeconomic, these are public builders, so they're active all across the country and not necessarily a Texas issue or Texas focus. Obviously, there are certain submarkets where you have overbuilding and there's slower home sales, but do you think that they're just looking at the big picture nationally and saying there's enough headwinds and concerns that we're going to kind of be conservative and slow down? Or do you think that there are specific Texas issues that are driving a lot of this?
Yeah, that's a really good question. I mean, it has to be a little bit of both, but I think it's definitely more of a national problem. I was talking to a land developer the other day that mentioned that a lot of these public builders, they still have a lot of lots in like a Chicago market, which has been on decline for a long time. And so, when you're looking at it in your D.R. Horton or Toll Brothers, one of these big builders, and you're thinking about just thousands and thousands of lots that you control across the country, it's pretty easy to just say, to your point, no more closings in 2025. We're going to take a 6-month break, 9-month break. We're going to push everything out we can. We're hearing the traditional, 18, 19% hard money to secure finished lots, which in some cases up here, we've seen developers put up 30, 40, 50% earnest money hard to secure lots, which is, I'd never seen that or heard of that before. Well, now that's pulled back. Now you have developers telling us, big public developers saying like, we can't put up more than 10%. It needs to be in the form of a note. I mean, it's just totally different than where it was. And again, I think we'll see that shift back. But I think you're right. I think a lot of it's national. For sure, we talk about this all the time. In our markets are so huge. There's always areas in Houston or Dallas, regardless of the market, that you should go develop, just in those specific submarkets or areas. And then there's times when, across the market, it's just going to be really challenging. And so I think right now there has been so much supply, and interest rates are really at an interesting time. Just they went up so fast. They haven't really come down like we expected, but they still could come down. And so I think builders are just having to be cautious right now.
I think there's a lot of belief that they're going to come down next year. Maybe the first and second quarter, there's going to be a couple drops. I think that might be why a lot of the home builders are trying to push deals till next year. And I think just different use types across the market are hopeful about that. I know Trump is really pushing for that. So we'll see kind of how that plays out. But when you're talking about single family, what I was thinking is, when you have the single family developer kind of investor groups out there, there's a very large, well-capitalized groups that can close and can hold long term. But historically, there's been a lot of smaller, kind of players in that space doing the smaller deals, that are maybe 50 to 200 acres, 300 acres, that are not very well capitalized. That really rely on builders being aggressive and builders, putting up all this earnest money to help develop lots. I mean, basically, the builders were funding lot development through hard earnest money on a lot of these sites.
Yeah.
I mean, how much do you think this is disruptive for those kind of groups? Because they can't go close land, develop lots if the builders aren't going to help them do it. That might create an issue for these kind of smaller to mid-size, tracts that are too small for the big, well-capitalized developers.
Yeah, I feel for those groups because we have a lot of those groups approaching us with our investment arm Ascent saying, will you look at these deals? We've put these deals together, to your point, 50, 100 acres, 100 lots, 300 lot deals. We put these deals together. It's taken us 1-2 years. We've negotiated everything with the city. We've got utilities. Everything's figured out. We had builders. And I was talking to a developer that said, it went from, I had builders on paper lots and it was just going to be a home run. And then I had builders, on finished lots and they were going to put up a lot of earnest money. And then I had it where it was all the way down to finished lots with a little bit of earnest money. And then the builders called me back and said, we can't do anything anymore. So it was like, it went from a home run all the way to these land developers still believe in these deals. But you're right. A lot of the really successful ones are smaller shops. And they've also got a lot of deal activity because the market was so hot. And so they're approaching groups like Ascent, seeing if they can come in and help. Can you help buy this property? And normally you'd be buying that property with builders in tow, ready to go. But instead saying, can you help buy this property? And can we just hold it like for a year? We won't have probably any builder activity. We got to get through just this specific submarket, what we're seeing. And then there could be an opportunity that we think will be a great opportunity. It's going to swing back because we believe in just the long term of what's going on. And that's important because if you lose that work and effort that went in to, a couple of years of trying to get a deal done, then we always get back into the position of, everybody shuts down. And when they try to come back, we have a shortage again. And then it just kind of gets out of hand.
Yeah, I mean, it's just such an example of how timing and capital are so key in our business because, a lot of these deals with patient capital, there's no problem because they're going to come back. We're just talking about a period of time, which in this case may be like 3 to 6 months. I mean, I could see the single family space, them taking a step back for just a little bit and then be back to the races again, maybe at 6 to 9 months on how long it is, but it may not be that long. But capital in our business is normally not patient. And so that will create issues and create opportunities. And that's why we always, from a land investment standpoint, believe in being all cash, being able to move quick, but also being patient. And if you have to sit and wait for a couple of years, be at a basis where you can do that and you can still get a good return for your investors. And because it's been so frothy, people have been putting themselves out there and taking way too much risk in the way they've underwritten these deals and thinking about the timing of these deals and the structure of these deals. And so that will unravel and is unraveling when that's just going to create more opportunity. So.
Well, it's interesting because that's one of the beauties of private capital. It's a danger too because private capital sometimes if they don't really understand the market or know, then there's not as many protections in place. But at the same point, private capital that's really in tune with the market can go and make these investments that whether it's the builder side or if we want to switch to the multifamily side. On the multifamily side, the institutions really don't want to take risk right now. They're concerned about basis. That's probably one of the most important things to whether you're talking to like a Carlyle or, one of these other big multifamily funds that's just trying to get money out into development. They're thinking about what's it going to cost to build this project because unfortunately with interest rates coming up, with pricing and rents where they've been, we're not seeing exits at very strong numbers when these apartment developers go to sell. A lot of developers are trying to hold and not sell. But if you're forced to sell, some of these exits are just at really low numbers. Like you're looking at pretty good suburban locations and they're selling for, $200,000 a unit in some cases, and those numbers don't work to go develop something new until we see construction pricing or rents adjust. So these big institutions are really focused on, okay, well, bring me an opportunity where there's some way that I'm going to be able to come in a lot lower basis. The flip side of that is we just closed a high-rise site in downtown Dallas with a group that traditionally uses mostly private capital. They invest a lot of their own money in deals. It was a site that they felt like they had a good basis, good location in the opportunity zone. They took a chance on it. And I think that, they're going to do really well. And a lot of it's timing. We were talking the other day and, they said, we believe right now in just a contrarian view of we want to be more urban where there's less development. And we hear this from some of the bigger institutional developers, but it's out of their control. Like they can't go raise the money to do it. But if you have the ability to tap into private capital, their comment was, we can go develop urban and we're going to be like the only game in town. We're going to be building these projects. And like we always talk about, you're looking 3 years down the road, maybe 4 years down the road if it's a wrap or a podium deal. And so they're going to be the only game in town, and that's going to be a really good position to be in. And then you'll have the institutional guys, trying to follow him at that point.
Yeah, it's incredible. I mean, there's definitely not going to be a lot of high-rise competition, so if they can go build a good product, and there's definitely a demographic that wants to live in those deals. And Dallas is a booming city, so it all really makes sense. But yeah, the infill market has been extremely tough. And I think the infill market in Houston and, Dallas are pretty different. But, in Houston, we have some very, dead infill areas that I just don't know when they're ever going to come back. The areas that used to be strong, like the Galleria in Midtown. And then there's areas that have been a lot stronger, like the Heights. Garden Oaks is another good infill market here in Houston. So we're seeing some activity in those markets, but pricing is still really low. I do think we are starting to see developers, make offers. We actually, put some deals in our contract in those markets, but we're also seeing developers with some capital. To go back to what you were saying earlier about what capital is looking for, I think the institutional capital is also looking at the sponsor. Mm-hmm. We're seeing that very clearly in Houston, where they're backing a couple developers, and they'll do deals with those groups, and then they're not really going to do deals with anyone else. And so, and I don't think there's very much institutional capital that's really willing to take those kind of bets. But we're seeing the developers that are the stronger sponsors that have that kind of capital start to relook at some of the infill markets for higher density product on a very selective basis. I'm talking maybe doing a deal, maybe you do 2 deals, but we're not talking about a lot of activity. And then also looking at the really strong kind of infill suburban kind of pockets. And we've actually put quite a few deals under contract in those markets at numbers that are, as strong as we've ever seen in Houston. I mean, surprisingly strong numbers from those groups, but it's not a broad part of the market. I mean, we're seeing a handful of multifamily groups who are still making offers, still strong. And then the rest of the groups are either not making offers or they're dropping deals. And unfortunately, we've seen some pretty good sites get dropped by some of these groups who historically have been good developers, but they're just not able to get the capital right now.
Well, and it's interesting because when we talk about multifamily, we both recently ran marketing processes on a couple sites that were developer owned, Dallas and Houston, kind of tag team these different properties for a few different developers. And we're always listing a lot of properties. We have a lot out, but these were both out around the same time, and they were urban properties. And it was interesting because just kind of talking about deals that are actually moving forward versus deals that are not. I can't remember what episode it was number-wise, but we talked about developers that are holding on to properties versus those that are saying, okay, I've been holding on, I probably need to now go sell. And this was a great case study of that. So we had one developer that approached us and said, I want to sell, I want to be out of these properties by the end of summer. And then we had another developer that said, we want you to take these properties out. They had already had them out with another broker. So, we weren't 100% sure if they were going to sell or had the conviction to sell that this other group did. So we took both these properties out. We got a ton of offers. I think we both had really successful campaigns on all 4 of these sites because it was 2 in each market. And we're really pleased just with the amount of activity, understanding the timing in the market, and how difficult it still is to underwrite structured parking. These were all structured parking deals. We were talking about how many offers did we get. I mean, we had, I think between the 4 sites, something like over 60 offers that we received, so a lot of offers. And interestingly enough, the developer that had said, we want to be out of this by the end of summer, we both ended up with hard money day one, which we don't see very often on land deals, but we both ended up with non-refundable money day one, significant. We're not talking, $2,000, $5,000, $10,000. I mean, we're talking 50, 100, multiple 100,000 type numbers. And we had that offered from several groups. That wasn't like one developer. And the developers that did offer it were all privately funded. It was groups that they've had capital, they've been waiting for the right opportunity. And when they heard, we have good relationships with these developers. So when they heard from us that like, this is a seller, they are going to sell. If you can show a very strong offer from a term standpoint, like hard money, you can meet this really fast closing timeline, then they're going to sell. And so we really saw some developers get aggressive. I mean, we just don't see that up here in Dallas on these, big projects that developers agree to close. But we had several offers where developers were saying hard money day one, we'll do a 30-30, we'll close really fast. We've already got the money. We basically just have to kind of like form the entity, check all the boxes on due diligence, and we can send you the money. So that was really interesting that's how that one went.
No, it was. Yeah. I think one thing that's interesting is I think when you have a developer who sells a site, the development community tends to pay attention because they know the site's been validated for development. And these were all in good submarkets. I mean, these weren't kind of bad submarket, bad deals. I mean, these deals made sense. Just both the developers that had them, there were reasons why they didn't want to build those deals, and it was time to sell. It was either we're going to keep holding for a long time or we're just going to sell. And so they decided to sell. But I think that the development community tends to pay attention sometimes more to an actual developer-owned site that they know has been planned for development versus just a general site where maybe there's unknowns and issues that would prevent development that no one knows about. And you got to get into due diligence and figure it out and go through plans and all that. So I think that was helpful. And then I think, like you're saying, the conviction that one of these groups had of like, we're going to sell. Like, just go tell the market, like, we're selling. If you want to buy it, come make an offer. People will respond very well to that. And we've seen this across the board, the opposite of that with several of our sellers, where there's been kind of this hesitancy of like, let's get it out there, but we're kind of not sure and we don't really know what we want. And when you go to market like that, sometimes you can get lucky. But I think this is a kind of market where the market's not rewarding that kind of a presentation. The market wants to know, are you really going to sell? And then the market's rewarding that with some better offers. And in the case of this other group, we actually had really good offers. I think maybe a dozen offers on each of the sites, some very high prices, higher than we were expecting. But they were in a position where they needed just a number that's not market today, that's well above the market. And we've seen that happen, over the last 12 to 18 months on some other sites where we've had developer-owned sites, and they've said, hey, we'll sell, but we got to get out at all of our basis, all of our holding costs, all of our get everything. You start to throw an internal rate of return on top of that, and suddenly they're at 2 times the market, literally 2 times the market. And so that's just, in a lot of ways, to me, it's like, just hold on to the property then and don't go to market, because I think that there's a reputational hit that takes when you keep going out and not selling. The market starts seeing that deal is not really a real deal, and that's unfortunate. So we're seeing that on both sides of sellers. Some really commit to selling and getting some pretty good numbers, and then some that are kind of tepid about it and they're not doing as well.
Well, you bring up a really important point. I mean, we talk a lot about you don't want to go false start your listing, where you take your listing out and then you pick the wrong buyer. The other way you false start your listing is you take it out and then you don't pick a buyer. And unfortunately, on that second listing, they didn't pick a buyer. And we both got feedback because, again, we were the second, if not the third broker to market those properties. We both got feedback from some really strong developers that we're doing other deals with, that said, like, we offered last time. We don't think they're sellers. We're not going to offer. And they actually would have offered probably in excess of where the other offers came in. And unfortunately, the point was kind of proven when there was no decision to move forward with an offer. So, I think if you're a seller that's in that position, probably don't want to go test the market with a different broker every 6 months. Like if you're not gonna sell in the current market, because we talk a lot about we don't make the market. We go and figure out what the market is, and then we, through our knowledge of the business and negotiation, will get you the best outcome you're gonna get. But we don't create a market that doesn't exist. And I think that we're just going to be in this position for a little while on some of these sites. And if you've been holding since maybe 21 or 22, to your point, whether you're adding on your internal rate of return or not, there is a cost of holding. And so that cost of holding is just going to make it more and more expensive for you to dig out of that hole. And so there's some cases that we've been tracking just because there was so much activity from developers taking land down in 2021 and 2022, and they never built those projects. You kind of just imagine that they're digging a deeper hole. Like every day, just the hole is getting a little bit deeper. And unfortunately, I think we expected coming into the year, a lot of those earlier episodes, just things were really turning around. There was going to be a lot more just general activity. A lot of the developers that, maybe weren't the bigger sponsors were going to be able to get debt, be able to get equity. Unfortunately, there's just been a lot of headwinds in Q2, and the uncertainty in Q2 has resulted in, it's been hard for a lot of those developers to get out of the ground. And they may have to continue to hold because the bigger sponsors are still getting projects done, which actually kind of makes it harder for them to get deals done.
Well, that's interesting conversation about just land prices in some of these markets. I actually had someone email me last night that we've done business with before in the Houston infill market. And they have a really good infill site. And, it probably is good to talk about when you think urban infill, there's different kinds of sites. There's like the high-rise site you were talking about, you guys just closed. And then there's these kind of, really good markets that are more wrap sites. Maybe they're podium sites, but those tend to be easier to get done than these really high-end, high-rise sites. And so in Houston, we have these areas of town where the whole submarket, people want $200 to $300 a foot. And I think with where rates are today, there's sort of this thought of like, well, the market's down right now, but the market's coming back. I'm not going to sell at 150 a foot or 120 a foot because the market's coming back and I could get 250 a foot. I think that's very foolish right now. And I had this guy email me last night and he's like, do you think that is the price of my property, is it worth more than 2019? I think that's a really interesting question because, I would say no. 2019 was a good market. Going into COVID, especially in Houston, there's a lot going on in the infill market. There are several high-rise deals. But we closed a ton of great deals back at that time that at kind of record pricing. And the capital was completely different. And today, if you're holding on thinking, I'm going to get back to $300 a foot or $200. In a lot of cases, these sites were never at $200 to $300 a foot. It's just that people wanted that, and there was sort of this belief if it's in infill and it's Kirby or Greenway or some of these Houston markets specifically where we saw some high pricing. Well, my site's worth that much too, and I think you just got to be very realistic as a developer. If you're sitting on a site like that or a landowner, are you really going to get back to those kind of numbers? And maybe were those numbers ever realistic to begin with? I don't know what you would say about that, Tom, but I think there's some people in really tough positions with some of those sites.
Yeah, I think that's true. I also got a similar email yesterday from a developer just checking in because we offered on their property a while back, just off market, probably a year ago, and maybe even 18 months ago, at a really large number. And this was post rates coming up and, really large price. And he wanted to know what's the latest. And I just told him, the truth right now is it would be pretty hard for someone to come buy your site. That's the difference of 18 months, is that you would have thought today would be a better market than 18 months ago. Had he selected that group 18 months ago, I actually think that it's very likely they would have closed, or they would have put a lot of money hard, which I think likely would have forced them to close. But that same group today now is on several other projects. There's just other sites. I think a lot of landowners don't realize that. They kind of get tunnel vision, and developers get tunnel vision on like they're the only site. But in some of these markets, they might be competing with like 5 other fully entitled zone sites with plans. That's what we're seeing right now in a lot of these areas. And so what's the differentiator? Sometimes other developers don't want your plans, so the plans are a negative. So it's like, what is the differentiator? But I told him, the pricing is probably 60% of where it was like 18 months ago. So he would be best to just hold at this point.
Well,
his situation is unique in some ways, but...
Yeah, no, that's right. And time kills deals. These offers, people make offers, and there's sort of like a snapshot in time of when they think that makes sense. And if you're a seller and you sit on that for a period of time, and it's crazy how a lot of these sellers will think, oh, well, this guy offered this 3 months ago or 6 months ago or even 8 weeks ago, I'm assuming he's still there. And you really need to make quicker decisions. If you get a good offer, and we've seen that recently with the group that got a really good offer, hard money day one, they dragged their feet for 3 weeks, didn't select the group, and the group was gone, when they wanted to select them. And it had only been like 3 weeks. And so we're seeing that a lot right now. If you get a good offer, don't get greedy and think maybe there's someone out there who can give me 2% more or 3% more. I'm also telling a lot of these sellers, just because someone offers better terms or a little bit better price really doesn't mean anything, because we're seeing guys drop deals right now. So look at the strength of the sponsor. Do they really have a story from a capital standpoint, whether it's a private equity story or they're using some personal money, or they actually have institutional capital? Really look at that, not just at, well, they gave me an LOI and it's $500,000 more than this other guy. And it's crazy how many sellers think of it that way, that they just look at the LOIs and they just try and pick the one that's the highest. And it really doesn't mean a lot right now.
Yeah, there's a lot of value that we're able to add in those situations. Just having so much history on who a lot of these developers are and where their money comes from, and sometimes the better terms are going to be the better buyer, and a lot of times they're not. And we see that in plenty of our marketing processes. We'll take a site to market a lot of times, and you always know a certain group is going to make you an offer, almost like without even looking at the site. They're just going to make you an offer on whatever price you quote them. And so for a lot of landowners that don't know that, they might take that offer, but that's very rarely the offer that you want to take.
Where do you guys see on the industrial side up in Dallas? It seems like that's been a really strong use type up there.
It's been really, really active. And I know we talked about that leading into the year, that industrial, multifamily both felt very active. And I would say fast forwarding to now, that's still continued to be the case. I mean, we've had certain areas that have just had explosive growth, areas further outside of town, because last year it was a lot of GSW, a lot of infill, industrial, really difficult areas to go find land. So it's a lot of redevelopment or just smaller projects. And so that's really where the market was focused last year. And then this year, there's been a lot more activity just in a broader area. So Denton, McKinney, the whole 75 corridor. Louisville has been difficult to get projects done, but there's a lot of demand and activity there. Kind of north of the airport, also down south of the airport, we're seeing a lot of activity. That's been encouraging, and it's been kind of everything. It's small projects. There's a lot of smaller developers that are trying to build these, smaller buildings and really focus on that niche part of the market. And then on the other side of that, you have developers going after some bigger deals again and really chasing, some of these much bigger users that are out there and build-to-suits that are out there. And so we've had several closings recently on the industrial front. Our offer activity has been really strong. And so that's been something that has been really encouraging. It feels like industrial has been more steady than for sure single family and even multifamily. Multifamily has kind of ebbed and flowed a little bit, and then industrial has stayed really steady and just continued to be really active.
Yeah, I think we've seen industrial be very resilient on some of these deals where you have other use types that are getting aggressive, but then kind of maybe pulling back a little bit. The industrial groups seem to be pretty steady in pursuing the deals they're pursuing and being aggressive. I would say we're not as in the same activity level that you guys have in Dallas and Houston, but we have seen the developers really broaden their focus from kind of the core beltway areas and the really good premium kind of sites that felt safe to now a lot of developers looking at the Grand Parkway, looking at some of these highways going a little bit further from town that they just weren't looking at in the past. So it's everything from big institutional deals to these smaller kind of industrial parks and smaller user kind of deals. I mean, what do you think is so far as impact of tariffs on industrial, or how would you look at that? I know the whole tariff thing is still, it's only been a couple months. I guess I don't know if it's been 8 weeks or how long it's been, but how do you think they're seeing the whole tariff issue?
Yeah, we're recording this episode at an interesting time because we're kind of after the initial shock of tariffs, but then we're kind of still prior to when this 90 days burns off, just when we're recording this. And so I would say, initially there was a lot more of a reaction on tariffs. Now, just everything we've talked about today, I would say single family is probably having the biggest reaction to tariffs, not necessarily industrial from what we're hearing. We're talking to some of the really active industrial developers they're active across the country, very active in our local markets. And they're all just trying to get ahead of any concerns around tariffs, just where they're sourcing materials, talking to subs. Some of them are doing so many projects that they kind of have some buying power. We're definitely seeing that on the multifamily side, where there's so many projects that they're basically just telling subs, like, you have to hold the pricing. And they're, at least right now, that's working. So we haven't really heard too many headwinds related to it. But again, it could change because of just where we are and, what could still happen there.
Do you think that on the single family side that the tariff issue is not as much a material issue? Because I think we were talking about was like a 2 to 3% increase in cost on the single family side from a material standpoint, but maybe it's more of a consumer issue where the consumer is pulling back a little bit. I don't know if it's because of tariffs or maybe it's bigger kind of macroeconomic issues. For some reason, they're not buying homes and the velocity of home sales isn't as strong. They're being more conservative, and so that might be a bigger issue than actually they just an increased cost of materials?
Yeah, I think that it's a good point. I mean, I know we've heard that on a $350,000 house here in DFW, the tariff impact is about 10,000. 9 to 10,000. So, that's going to be on that. I guess that's about 3%, like you said, 2.5%.
Yeah.
So it doesn't seem like it's a huge impact, but there's a lot of other things just going on, right now.
Yeah.
We've had a lot of really interesting legislation that's passed that really has more to do with multifamily. Although I would say if the legislation passed ends up panning out the way that it could, where you see a lot of these commercial and office properties that get redeveloped into multifamily, that has an impact on industrial, because I think some of those properties could have been industrial. And, that could be why one difference between Houston and Dallas with you guys not having zoning is a lot of good industrial sites have just been picked over the years and become some other use. And then now that industrial would want to go there, they're already developed and it's difficult to redevelop them. Whereas here, those sites remain undeveloped. Like some of these really incredible sites that are selling at record numbers for industrial, some cases they've never been developed. And I think a lot of that has to do with zoning, because if they weren't zoned, another use would have gone to those properties over time.
Yeah, and I think the point is well taken about Houston, where you have all these other types of little developments that can kind of fill in a market, where you still have available sites in a suburban market that could be a great industrial market, but none of them are big enough. There's plenty of like 10-acre sites and 15, 20-acre sites, but there's not a lot of bigger 40 to 50, 60-acre sites available unless you start going a lot further out to unlock those kind of deals. That's a good point.
Well, the last thing I was going to say as we kind of wrap up was it's interesting. We're talking about deals moving the market, and I would say Q2 across all of our markets had more headwinds just with tariffs and just some of the uncertainty that we're seeing. But at the same time, from a activity standpoint, we really have not seen activity drop off. For sure, from a closing standpoint, I think we will have closed close to 50% more deals in Q2 than we did in Q1. So I think that's really interesting just to think about. And it's another reminder that these developments take a long time. We get really caught up in the moment, but these developers are thinking about down the road several years. And so again, from a landowner perspective, you don't want to get too caught up in the moment. If you can get a quality sponsor working on your property, spending money, I'll have landowners tell me all the time, that's just an option contract. If they don't close in 90 days, it's not real. But it might be Trammell Crow and they're saying they need 9 months. Yeah. And 9 out of 10 times, if not 10 out of 10 times, I'll go see that landowner 9 months later. No one's under contract. They're still asking for a 90-day close. And so I think a lot of the closings we're seeing are landowners that were flexible to work with developers and gave them the time, and developers that were real developers that had to solve challenges, had to get difficult projects capitalized, or in a difficult market to capitalize, but they got it done. And that's, at the end of the day, I think our goal is always, how do we get to the finish line for these landowners? And a lot of times you have to be willing to work with these developers.
Yeah, and I think the point about deals closing, we're seeing a lot of deals close for DMRE in Q1, a lot closing in Q2, and I'm hopeful there's a good pipeline in Q3 and Q4. This is a kind of market where you can work really hard and waste a lot of time and work with the wrong deals with the wrong groups and have nothing close. And I think we're seeing that with a lot of brokers in the business, a lot of our developer clients, who are not seeing deals happen. But we've been doing this for a long time, and the longer you are in this business and you sort of play this game that we play every single day, you get better and better at figuring out where are the real deals, who are the real sellers, where are the sites that actually make sense in today's market, who are the real developers who can get those deals done, who can get them capitalized. And we're not always right. I mean, sometimes we make mistakes, or sometimes the market will change and we'll take a deal off the table that was valid 3 months ago, or there could be side issues that come up. But I think it does speak to our experience and just picking the right horses to ride, that we have so many deals closing in a market where there's really not a lot closing across all these markets.
Well, Tim, I think that's good. I couldn't even tell you were jet lagged, so thanks for doing this morning. I think this was an interesting conversation. We're in interesting times just in the market, but also fun times. We're getting to work on some big projects, and so rooting on all of our clients and looking forward to helping more of these landowners just manage what we're going through in the market.
Yeah, it's a lot of fun. It changes every day and it keeps things interesting. So that was great.
thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.